This is Eric Birch from miningclips.com, and today I'm speaking with Mark Fields, a veteran of the mining industry with over 30 years' experience. Welcome to the program, Mark.
Good morning, Eric, and thanks for inviting me.
Oh, you're very welcome. We've known each other for a little over 6 years now and discussed on many occasions the factors that impact public mining companies and exploration companies. And today I'd like to focus on the global cost curve and the copper market specifically as an example to help bring out some of the important points for investors in the public mining and exploration sectors. Now, Mark, you're a professional geoscientist, you hold a Bachelor of Commerce, and you've worked for a variety of junior mining companies over the years, evaluating projects, advancing them, financing them, and even building mines. You also worked for Rio Tinto through the better part of the 90s and told me that has had a strong influence on how you evaluate projects and the commodities markets. And so, getting back to our discussion, Mark, please share your thoughts with what you believe to be one of the most fundamental factors for a particular commodity, the global cost curve.
That's certainly something that was drummed into me when I was working at Rio Tinto, Eric. And really, the mine, it's got to be on the lower part of the cost curve to be a worthwhile asset through its whole mine life. Otherwise, it's simply losing money too regularly. And so the whole concept for Rio Tinto was, as far as I was concerned, was looking at a project, make sure it could potentially be on the lower part of that cost curve, and that would make it a moneymaker through most of its mine life. No, in the exploration and development phase, if a project's going to be on the low part of the cost curve, but you must make a case, a reasonable case for it, that the expectation is that it will be on the lower half of that cost curve. And I guess a good example to use in this, because it applies to all commodities, is copper. Because copper sits a widely used commodity throughout the world, also produced from mines around the world as well. So I think it's a good template, a good example to use to understand the global cost curve for any commodity. So let's use copper for doing that. And we all recognize right now there's been a lot of difficulty in the industry overall, and that certainly applies to the copper industry as well as be it gold, silver, uranium, whatever it might be. So to find a cost curve, it's not that difficult. One simply goes into Google, types in a search looking for a copper cost curve, and you'll find a number of them there. They're all publicly available. The one that I would like to use is one that I simply found by doing that Google search, and it's provided by SNL Metals and Mining.
And that's the graph that we have beside your picture on this video audio clip here.
Excellent. So that's I'll talk to that graph then. And there's a lot of information in that graph, and a lot of very, very important points can be taken from that. What it is doing is plotting the data for the cumulative copper produced around the world. In other words, begins with the lowest cost producers on the left-hand side of the curve, and then gradually more and more copper is produced at higher costs. And then at the end, according to this graph, there's say 27,000 million pounds of copper produced annually around the world. And the ones on the right-hand side are the highest cost producers. So you can see from a cumulative basis how the cost curve increases from the left-hand side, working our way over to the right-hand side of the graph. Now, one thing that's important to note here is that this is the total cash costs.
So these are not all-in sustaining costs, just the cash costs of production.
That's absolutely right, Eric, and that's an important point because one can say typically as a rule of thumb here that these are the on-site costs, and they represent perhaps about 75% of the total cost of a mine producing copper. It does not include off-site costs, such as, for example, the head office administration, the finance costs that may be ascribed as debt for the capital cost of building the mine, depreciation, that type of thing for the trucks, the equipment they're using. These are important costs because they are very real costs. But the cash cost, that shows the cash flow a mine might be producing or not if they're on the high end of the cost curve. So yes, it is only the total cash costs that's being shown on this curve itself. So if you look at the left-hand side of the curve, you can see that there's some very low-cost mines. Some of these mines produce copper for less than $1 per pound. These mines make money every day of the year, their whole mine life, for the companies that own them. And they make a lot of money. And even at today's price of a little bit over $2 a pound, say $2.10 a pound US, they are still making a lot of money for their owners. If you move to the middle part of the graph, which is the bulk of the production, it's a much flatter part of the cost curve. And these mines are also, for the better part, making money for their owners. Not a lot of money at this point in time, but their cash costs are generally between $1 and $2 a pound. So again, on a cash cost basis, these mines, even today, are making money for their owners.
Yes, there's still a margin at even at $2 copper.
That's exactly right. Now, you have to remember, we are ignoring the total cash costs, but on a cash cost basis, these mines are cash flow positive even today at today's copper prices. Now, what's important here, though, and this is where you can start to see some of the impact of today's prices. At the far right of that curve, all of a sudden, the slope of the line tips up very steeply. And these are the ones that are known as the high-cost producers. And this is a very typical cost curve you see for any other commodity as well. So these ones on the far right, they're the high-cost producers for whatever reason. It might be the grade, the size, infrastructure, where they're located, whatever it might be. These mines need a high commodity price to make money during any part of the cycle. And these are the mines that today, they're losing money. They are losing money even on a cash cost basis at this point in time. So those are ones certainly at the greatest risk of being shut down at this point in time. So when the copper is selling for $2.10 a pound, you've got this, visually eyeing that graph, perhaps 20% of the global production losing money at today's prices.
Wow, that's an incredible amount. And I guess the longer copper prices stay here and when other costs start to increase, we don't know when oil is going to go up. Certainly there have been a lot of predictions that oil is going to remain pretty much flat throughout 2016, but it can change quickly.
That's absolutely true, and that's a good point, Eric, about the oil, because this is a cost curve, as we've talked about, and there's many, many inputs that go into this cost curve, a lot of things that are sort of buried in here. And a very important input is the energy cost, the cost of oil, either to produce it at the mill level or for the fuel that goes in the trucks. These are all input costs. And when the price of oil has gone down, as it has, that has lowered this cost curve for all the mines. Because the cost of oil has gone down, so their costs go down as well. It makes it better for all the copper producers, except those in the United States, of course.
Most definitely.
So again, there's a lot of subtle things that are buried in these cost curves you have to be aware of, the energy costs, foreign exchange costs, whatever. And that's why you will see that many of the costs for the copper producers, and it can be applied, as I said before, to gold producers, any other commodity as well, lead, zinc, silver, whatever it might be, they have come down because of the foreign exchange results, because of the energy input costs as well. So you'll see most of the cost curves, in fact, have declined over the last year or so, but not to the degree that the commodity price has in fact gone down.
Right. Well, I thank you for your insights on the cost curve situation, and perhaps you'd like to give us just a quick summary on that.
Yeah, so I think looking at this curve, you can see that the majority of copper mines are still making money, but not nearly enough money to really make this copper industry an attractive place for capital investment to occur. So you see that the costs have come down quite substantially, but the margins are small. So there's a lot of pressure on the high-cost mines on the cost curve, and even on the middle part, begin considering reducing the production, even shutting down entirely. So I guess maybe an analogy that I can use is that if one is in a hospital with an injury of some type, the health staff will often, they want to manage the pain. And they may ask the question, say, what's your pain on a scale of 1 to 10? 1 being minimal, 10 being excruciating pain. Well, I would say that up until October, I guess the cost and the revenue side of the copper industry, the pain was, say, about a 5. But for the last 2 months, when the price has gone down to just over $2 a pound right now, the pain has increased, tracted up to about, say, an 8. So I would hope that it's time to start to manage that pain more aggressively than has been done in the past by trying to manage some of the supply that we're looking at as well in the world, for the world copper mine.
Well, certainly, if they don't, we're most likely going to be seeing additional mine closures and more supply come off the market.
That's exactly what's going to begin to happen more and more, Eric. Absolutely. And that's what's needed, of course, as we all recognize, but the question is who's going to do it. But it will certainly start to occur, I'm sure of that.
Well, Mark, I'd like to thank you for joining us today, and I'm very excited to discuss the supply side of the equation. We're early with you in the new year. Certainly, we'll get a little bit more information after the Fed rate decision in the U.S. tomorrow. Pretty much everyone's pricing in a small rate hike here, but the first since the financial crisis. So things are going to be changing in 2016, and it'll be interesting to see how things unfold. So again, thank you for joining us and sharing your thoughts with us today, Mark, and hope to talk to you early in the new year.
Thanks very much, Eric, and I look forward to that as well.